Crude oil, daily forecast, April 29th, fxempire.com. The crude oil, light sweet crude markets, as you can see, fell during the session on Friday, but found enough support at 92 to bounce and form a hammer. This hammer does show strength, but the biggest problem we have right now is, quite frankly, there's so much noise just above it. With that being the case, then we simply would prefer to sit on the sidelines and wait and see if one of two things happens. If we manage to break above the $95 level and get a nice solid daily close above that, we think that this could be a real breakout point. But at this point in time, this feels a little tired. And even though buyers are willing to step back in the market, we think that there is enough between here and there that could cause problems. Alternately, we could see the resistive candle appear somewhere in this general vicinity that makes us sell, perhaps a shooting star or something to that effect. That, of course, would be a nice selling opportunity, and we should pull back at that point to roughly around 89.50 or so. We think that we are simply carving out the summer range right now. It could be a fairly quiet summer, and that might be what we're doing, just essentially trying to build that foundation. Looking at the Brent market, you can see very similar candle. Found enough to form a hammer, but we see an area that is right about here at the 103.50 area or so. That should cause enough resistance that we more than likely find trouble above. That should keep this hammer from being overly influential. We think that this failure could indeed turn this hammer kind of against itself, so to speak, as traders cover their positions and we continue to sink lower. We expect it to be a relatively quiet summer, like I just said, but we think right now we're just laying the groundwork. And that being said, it wouldn't surprise us to see this little area here be the consolidation, or possibly as high as 160 or 106.50, which we think is significant resistance at this point in time.